The phrase K-shaped economy has been thrown around a lot in the last month or so, specifically in the financial community. It's hard to read an article, listen to a podcast without the K-shaped economy coming up. So in this video, we're going to cover what is the K-shaped economy, why are people talking about it, and then finally, what are some causes and what are the potential market implications of this being our reality. So what is it? Let's define a K-shaped economy. So AP News had a good quote here. The upper part of the K refers to higher income Americans seeing their incomes and wealth rise, while the bottom part points to lower income households struggling with weaker income gains and steep prices. So I set up this little K for you. You'll see a lot of charts in this video that are going to have this shape. And then we have this cartoon from the Buffalo News in 2010, actually. So this has been something that's obviously been talked about a lot. You have the elephant Santa with the big bag of money going into the super rich house, looking down on the more modest house, saying their chimney's too small. Just the dynamic of, the rich, the super big house, things are going well for them. And, the unemployed, in this case, in the more modest house, they're not getting any gifts from Santa. Okay, so frankly, the economy is not working for everyone. So the K-shaped recovery, companies are thriving and consumers are starting to lose hope, according to the data. Here we have consumer confidence in blue and the forward EPS for the S&P 500 in red. And if you look at the clip chart on the right, we even drew a little K here so you can see the shape. We've had S&P 500 forward earnings spike over the last few months. In this case, looks like 9-ish months. And then on the flip side, during that same period, consumer confidence has tumbled. So earnings for companies are looking pretty good, but consumers are not feeling great about the economy right now. This is another, believe it or not, this cartoon is from 2008. Just this slide is just to show that the Fed is also not aligned right now with how consumers are feeling. So we've gotten a bunch of rate cuts, right, where we're worried about inflation. And if you look at the chart on the right, you'll see why the Fed is less concerned about inflation than how the public feels about inflation. And that comes down to the Fed generally views CPI on an annualized basis. So they're looking for under 2% or around 2% annual price increases. However, when prices go up 2%, 2%, 2%, 3%, during COVID, we had 8%, 7%, 9%. The absolute price of these things explodes, right? So shelter cost, daycare cost on the left axis here. These are not annualized. You see, these prices have just continued to go up. So while the rate of inflation has come down, consumers aren't paying a rate, right? They are paying an absolute price. And so, this was back in 2008, not exactly apples to apples. This is from The Economist, but, I thought the cartoon was pretty funny. You see the bankers in the hot air balloon. Time to drop the interest rates again. Any movement is being weighed down by U.S. consumers who are not benefiting from the rate cuts that are being undertaken. If anything, there are risks of reigniting inflation. So you can't just look at the price side. We also need to look at wages. And that is another, what I will call a K-adjacent chart that I will show you here. So right now, wage gains have not been felt equally across the board. And you can see that in the clip chart here on the right. The reason why I call it K-adjacent is because the red line, the wage growth line of the top 25% of earners, isn't actually moving higher. It's relatively flat. However, when you compare that to the reality of the wage growth of the bottom 25% of earners, or the blue line here, that has moved meaningfully lower since the end of 2023. So at the time where consumers are experiencing higher and higher absolute prices, even though the inflation rate has moderated a bit, at the same time, the wage gains that they have experienced have fallen greatly in compared to sort of the flat trend line that we see here with the top 25% of earners. This is just another chart. I could have shown 20 charts that showed this similar dynamic. Um, so basically, what has this caused? Well, this gets talked about a lot. The income and wealth inequality in the U.S. Again, the economy is not working for everyone. If you look at the percent of U.S. wealth, the top 1% versus the bottom 99% on the left-hand side, you can see the top 1% continues to make gains, and the bottom 90% is losing. Then we look at the right, similar way of showing this, but this is just the top 0.1% versus the bottom 50%. A couple crazy stats here. The top 0.1% makes up just 135,000 households, and the bottom 50% makes up 65 million households. And right now, those 135,000 households account for nearly 13% of all U.S. wealth. They're just astounding statistics. So what's caused some of this? So we've had an inflationary backdrop since COVID, and that has generally benefited asset owners. So equities and real estate have seen a massive appreciation. So this chart on the left here is the assets of the top 20% of earners. Corporate equities have been up almost 90% since 2019, and then real estate 67%. So the top 20% have seen their equity holdings appreciate and their real estate holdings appreciate. Then we look at the pie chart on the right here. You can see the equities are the largest single asset of the top 20% of earners. So while inflation has whittled away at some of the real income for a lot of Americans, the asset owners have actually benefited as corporations have done particularly well and real estate has done particularly well. So what is AI's role in all of this? I've seen this chart or graphic floating around the internet. I don't know who created this originally. If you do know, please let me know and I would love to give them credit. But it's the AI K-shaped economy, because this is something that people have pointed to as a cause of this, right? Where AI has made it so the lower income jobs are less needed, maybe, right? Maybe AI can replace some of those tasks and responsibilities. And then on the higher end, the people that are making higher level decisions and ultimately getting paid more, they're actually going to become more productive because of AI. Is that something that we're seeing? Well, it's still too early to tell. And this chart on the left, I don't want to jump to too many conclusions, right? In particular, correlation or causation. I like to, it's a big hurdle for me to think that NVIDIA's stock price and the unemployment rate of 18 to 24-year-olds, that there's any causation there, but it's an interesting pattern that we're monitoring. So right now, youth unemployment rising is happening in tandem with NVIDIA's stock price soaring. When you look at some of the data, this is from the Institute of Supply Chain Management. Which companies are considering AI, automation, or some digital capacity? You can see 27% said they would in 2025, 34% said they would in 2026, and only 27% said no, absolutely. So this is a trend that we're thinking about. Is it harder for younger people? Is it harder for lower income people to find jobs and work their way up when companies are more and more turning to AI to do some of those tasks? And then what are the market implications, if there are any? Now, if you've been following the Macro Institute and some of my videos for a while, you've seen this pie chart on the right before. Consumption is almost 70% of GDP in the US. And if you look on the left, consumption is the main driver of EPS growth. So we have retail sales in dark blue and the S&P EPS in light blue. You can see a very tight coincident relationship here. When consumers are spending money, companies are doing well. When they're not spending money, earnings tend to contract. Now, higher income people obviously spend more than lower income people. However, there are way more, as you saw from those charts. The bottom 50% was 65 million households. So if that group, as a group, starts to struggle, we would likely see a slowdown at some point in consumption. Now, this is just not something we have seen yet. It has been buoyed by stimulus in the pipeline, as well as, again, higher income people are doing well and still spending money. But if we were to see a contraction in consumption and retail sales, that would affect S&P 500 earnings. And earnings growth is the main driver of equity markets. So you can see this relationship here, the same S&P 500 EPS series in light blue, and then the S&P 500 itself year over year in red. Earnings fuel S&P 500 returns. It's a very tight relationship. So if you did see consumption or retail sales contract, that would flow through to earnings, company earnings do less well. And in that instance, we would generally expect the S&P 500 to not do as well. Now, this isn't any sort of market call. We are just saying, what are the implications if this trend continues? That's what I'm going to leave you here today. I hope you enjoyed this video. If you did, please subscribe to the channel. You can expect more and more content like this, educational content coming from the Macro Institute in the near future. We greatly appreciate you being here. Have a great rest of your week.